It's also been an exciting year in the bond market. Joining us now to discuss the oft-overlooked muni market, Sean Carney, head of municipal bond strategy at Blackrock. So, Sean, let's just talk a little bit about the inflows you're seeing to the muni sector so far this year. You guys are saying it's driven by retail investors. How is that changing, I guess, some of the dynamics and what maybe muni investors are expecting from that market right now?
Yeah, with retail driving demand, it's a much more natural buyer of the asset class. When retail invests, they tend to stick around for longer, as opposed to non-traditional buyers or crossover buyers of the asset class, which come in when they see value and then exit. We find that this is a much more sustainable type of trend. Year to date, we've seen $71.5 billion come into muni mutual funds. That's a record. Surpassing $70.5 billion set back in 2009, and the characteristics of this show that it's more sustainable and likely for funds to stick around longer.
So let's unpack a little bit about why retail investors are hopping in. I mean, what sort of trends is it? Is it structural changes in the ease of being able to get their hands on these muni bonds, or is it kind of just market forces that make it attractive for them relative to other asset classes to invest in?
Yeah, we believe that it's a couple things. Post the Tax Cut and Jobs Act, there were a couple things in municipal bonds that changed that really strengthened the technical underlying of the market. Thus, demand is significantly greater than supply in a world where issuers no longer have that avenue to advance refund issues. Gross supply is down. Thus, we're seeing greater demand from retail, which is really driving a strong technical picture, so you're getting strong performance. Also with that, we're noticing that retail is thinking differently about municipal bonds. At one time, they were thought of as a tax harbinger for the rich, and that's simply not true. They're also a great diversifier against equity and equity-like risk. They're negatively correlated to equities, lower volatility, high credit quality. And today, in a relative value market, an intermediate AA rated municipal bond compared to a AA intermediate corporate bond, tax adjusted, the municipal bond outyields the corporate bond all the way down to the 22% tax bracket. So we're seeing a broadening base of municipal bond investors. We believe that's what's behind the strong retail demand.
And then just thinking about where the Fed fits into all this, and I guess more broadly also the economic cycle, right? Because, as you outlined, the muni bond market has some idiosyncratic dynamics, I guess you could say, but certainly where the economy is overall and what the Fed is doing plays a role there. So I guess in your guys' view, where does the economy stand right now, and how does the Fed's likely moves play into your picture of the muni market?
That's a good question. If you think about when we came into the year, the Fed was talking about 3 rate increases, and now we've undergone 2 rate cuts, and in October next week, likely to undergo a third. So that shift has changed the dynamics of munis. Year to date, investment-grade municipal bonds are up 6.75%. It's a good mix of price return with 10-year interest rates lower by almost 100 basis points, as well as coupon return. And we may be getting later in the cycle. The Fed's talking about a mid-cycle adjustment. There are certainly signs that we're later in the cycle, but municipal bonds are defensive. And even when interest rates rise, as we saw in 2018 and over the past couple of weeks, that defensiveness in munis really shines when compared against other fixed income assets.
I want to come back to a point that you brought earlier about corporate bonds and kind of the relative value to muni bonds. It's been interesting to see the corporate bond market because of just the amount of issuance that we've seen, right? I mean, you could argue that we've never seen corporate bond issuance of this type, especially, at the all-time highs that we're seeing 10 years out from the financial crisis. So from that standpoint, I mean, are you seeing a lot of kind of inflow versus outflow from corporate bonds into muni bonds because of that kind of, not necessarily flight to safety, but given the pressures right now, there is some concern that the corporate bond market might blow up at some point? There
is, and we've seen more issuance lately in the taxable muni space, which is somewhat of an equivalent. The one thing to think about is the massive amount of corporate issuance on the municipal side. I mentioned we're seeing less. This will be a net negative year. If we print gross issuance between 350 and 365 billion, that seems about right. It'll be a net negative year, meaning more bonds are being removed via calls and redemptions and maturities than are coming to market. That's important because the return profile of a net negative issuance year, a year when the market shrinks, is significantly higher than in a net positive year.
Yeah, and I guess just thinking also about some of the dynamics we've seen in the credit markets, and mostly with private borrowers and the PE bid in that space. Has that changed? And I know we started the conversation talking about the retail influence on the muni market, but just the way that big credit funds now play in the market and perhaps the way they might not have used to. Does that change what you guys see in the muni market? And of course, the bond market more broadly.
Yeah, it does change things a bit more in the high yield space within munis. And the high yield sector in munis is a subsector sector of a subsector. So you're talking about a smaller slice. Year to date, 30% of flows have gone towards high yield, while high yield issuance only accounts for about 6%. So you can see the real dynamic there between the amount of demand chasing fewer bonds. More and more of these private types of deals have been able to come to the market. Oversubscriptions are very strong, but again, kind of in a smaller portion of the market, separated from that IG typical space of where typically you see mom and pop and traditional retail investors.
All right, Sean Carney with Blackrock. Appreciate the time. Talk to you soon.
Thanks for having me.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.